The purpose of today's conference is to bring together academics, policymakers, and practitioners to consider what are the implications of an extended period of low interest rate environment in terms of what implications it has for the actions of different players in the financial sector, what sort of risks it brings about. Does it lead to a search for yield, not just by banks, but also other non-bank as parts of the financial sector? How should we think about these effects, these risks, this fragility? Will it be easy for central banks to exit from this policy? When might the exit be? And how should regulation of the financial sector deal with the fact that some of these interest rate effects are going to affect not just banks who are within the current perimeter of the regulation, but also the parts that are outside, the shadow banking and so on?
If you look at any speech by, I would say, 95% central bankers in the world before the crisis, there was this sort of benign neglect view of asset price boom and bust, where they would essentially say, sure, I care about the boom. I care to the extent that it creates pressure on prices, but I'm not that concerned because if a bust comes, monetary policy will be able to mop up the mess. So there was this problem of asset price booms and busts that fell into a sort of a policy no man land, where the monetary policy authority, the macro guys, were saying, well, look, this is what the banks are doing. It should be the job of regulators. But the regulators were looking at too much to the nitty-gritty to some extent, too much to individual banks and too little to the system as a whole.
QE and other extraordinary policies work in two ways. There's a demand-side effect and there's a supply-side effect. On the demand side, by taking rates down to zero, you leave everybody desperate for yield. And investors across the board are reaching for yield to plug the hole in their pensions and buying riskier and riskier assets to do so. In addition, though, there's another effect on top of that, and that's the supply-side effect. QE, in particular, simply takes assets out of the system, and even through the LTROs, again, when bonds are not rehypothecated, as we add up net issuance across asset classes of govies and credit and equities, basically you were running at about $4 trillion a year globally prior to 2008, 2009, and now, by the time we subtract out what the central banks have been absorbing, we're down to about $1 trillion. So what happens when you put together increased demand with reduced supply? Prices go up.
In terms of where we are today, with near zero interest rates everywhere, are we witnessing a series of new bubbles being created? The thing about QE, it's like a love affair. Easy to get into, impossible to get out of with any dignity. That's what I fear we're witnessing now. So I'm a bit confused about what the implications both your talks are going forward.
So the implications are that monetary policy rates, they need to be low right now if you care about unemployment, output, stability. If you care about that, they are very powerful too.
The cost of low levels of monetary policy rates are the following. On the one hand, what we show is that they create new bubbles. If they create new bubbles, what it might happen is that we are generating the future crisis with these levels, low levels of shorter interest rates, and that's dangerous. So the medium-term effects could be very dangerous. On the other hand, the shorter effects are positive to increase credit and to increase output and employment. So you have this trade-off.
My question was, what are the benefits and the costs? There are benefits and there are costs.
As a summary, I would say that there are costs and benefits of shorter interest rates. The new macroprudential policy could change these benefits and costs, but so far this policy is too new, and maybe in the future we'll do it, but not right now.
I think there's definitely a consensus that there are dangerous asset bubbles being fueled at the moment. I don't think it's necessarily a bad thing. I think it's a sign of the times. Perhaps the days of high interest rates are over because we are in a deflationary world. And that's only going to become more and more obvious as efficiency grows because of technology and the opportunities for growth just diminish.
I mean, it's not that we don't know what to do. I think it's fairly clear what needs to be done. But the political obstacles are huge. The institutional obstacles are huge. And that's where maybe we need more interaction between the research and the policy and the private sector.
Every firm I know knows full well that they have to deal with a zero interest rate environment and that it won't last very long, but they've got to live in that place right now. There's certainly a risk that the maintenance of a zero interest rate policy is building risks for the future. I think the interesting thing is that the central bankers and policymakers are actually quite alert to this, and hence I think one of the things that we're discussing is how open they can be about their exit strategies as a way of alerting the policymakers to the risks that do exist from the current level of low interest rates.
I would say the three main factors are one, that a set of financial firms such as credit mutual funds are going to lose value and face an exodus of investors when the interest rates are corrected. The second main factor is that the long interest rate environment hasn't really led to substantial growth and recovery in the real sector. And so the exit is happening at a time when the economy is not as strong as one might have expected it to be. And the third factor is going to be that the corporations have become reliant on this interest rate policy for a while, which is that they're going to now have to generate value not just by issuing debt and repurchasing shares, but now they're going to have to focus on real sector value generation for a change. In my personal opinion, the biggest risk of the low interest rate environment is that it creates asset price inflation across board. Investors get used to low interest rate environments for a long time. They don't exit from this strategy. They do so only when the central banks indicate any signs of exit, and this leads to high volatility in asset markets.